Hello everyone, I hope you are doing well. And in this video, we will be discussing about the basic meaning of cash flow and the cash flow statement. So, the cash flow refers to the movement of the money into and out of the business organizations or the individual's accounts over a specific period. It is a critical indicator of the financial health as it shows how well an entity can generate cash to meet its obligation, fund operations, and invest in growth. There is a detailed breakdown of what cash flow means and its different components. So, types of cash flows. The types of cash flows are the operating cash flows, that is the OCF. Definition: the cash generated or used by a company's core business operations. Importance: it indicates whether a company can generate the sufficient positive cash flow to maintain and grow its operations or not. Then third is the components. That is the cash receipts from the sale of the goods and the services, cash payments to the suppliers and the employees, cash paid to the operating expenses such as rent, utilities, and other overheads. For example, a retail store's cash inflow from operating activities would include cash from the sales, less payments for the inventory, wages, and store maintenance. So basically, when we are talking about the operating cash flow, then the operating cash flow is nothing but a cash generated or used by a company's core business operation. For example, if I am making a cloth, then the cash generated or used by me in order to generate that cloth will be considered as my operating cash. Now, it is needed to identify if the company can generate sufficient positive cash. Okay, which components are, अगर हम बात करें इसके components की, so its components are number one, cash from sale of goods and services. After that, cash payment to suppliers. And after that, we will talk about cash paid for operating expenses such as rent, utilities, and other overheads. For example, a retail store, cash flow on operating activities would include sale payments, okay, regarding the business. So this is it. Now the second comes investing cash flow. Now let us just first read the investing cash flow. The investing cash flow or the ICF. Cash used for or generated from investing in assets and investments. It reflects the company's investments in its long-term growth. Its components are The purchase of the property, plant and equipment, that is the capital expenditures, proceeds from the sale of the assets, purchases and sale of the investment, that is the securities. So, cash used or generated by or for investing in assets and investment. It reflects a company's investment in its long-term growth. So its basic components are purchase of property, plant and equipment, proceeds from sale of assets, and then comes the purchases and sales of investment. Investments by here I remain securities. So if a company is purchasing shares, that means it is a part of the investing cash flow. Okay. Now, a tech company cash flow from investing activity might include the purchase of new servers and the sale of old office buildings. This is what when we are talking about the investing cash. Then the third type, which is the financing cash flow. Let us just read it. The financing cash inflows related to the changes in the company's capital structure. It shows how the company finances its operations and the growth through the borrowing, repaying debt, and equity finance. The components might include the proceeds from the issuing of the shares or debt, repayment of the loans and the other borrowings, payment of the dividend to the shareholders. The manufacturing firm's cash flow from the financing activities might include the issuance of the new bonds and the repayment of the previous loan. Okay, so when we are talking about the financing cash flow, it includes cash related to changes in a company's capital structure. Okay, it shows how a company finances and its operations and growth as well through the borrowings, repaying of debt, and equity finance. Now the components are proceeds from issuing shares or debt, repayments of loans and other borrowings, payment of dividends to the shareholder. For example, a manufacturing firms Cash flow from financing activities might include the issuance of new bonds and the repayment of a previous loan. Okay, so this is the distinction, like, or I should say, the bifurcation between the three types of the cash flows. Now, let us just talk about analyzing the cash flows. The cash flows can be positive and the negative. Positive cash flows, indicating that the company has more cash coming than in the original than the going out, which is essential for the expression paying dividends, reducing debt, and the other financing activities. Negative cash flow suggests that the company is spending more cash than it is generating. While this might be concerning, it is not always bad, as it could be due to the significant investments in the future growth. So, for analyzing cash, we can say, let us just first talk about the positive cash flows. More income and less payments. Ideal for expansion and other financial activities. Then is the negative cash flows. That is more payments and less income. Concerning, but not if the investments are made for future planning. For future plans. Okay. Then comes the free cash flow. So basically, the cash that the company generates after accounting for the cash outflows to support the operations and maintain its capital asset. Cash which a company generates after accounting for cash outflows to support operations and maintain its capital asset. Free cash flow is equals to operating cash flow minus capital expenditure. And it indicates the amount of cash available for the expansion, debt repayment, dividends, and other purposes. Let us just consider an example. And this example says that the cash flow for the year ended December 31, 2023 cash flow from the operating activities. Okay, cash flow from the operating activities. It is as follows. Here, the net income is rupees 10 lakhs, depreciation is rupees 2 lakhs, amortization is rupees 50,000, loss on the sale of equipment is rupees 10,000. And the changes in the working capital are 1 lakh, decrease in inventory is rupees 50, increase in the account payable is 1 lakh 50. So the total net cash provided by the operating activity is rupees this much. We calculate it. Example, let us bring out the calculator and let us solve it. So 10 lakh minus 2 lakh minus 50,000 minus 10,000 plus 1 lakh sorry, total income is rupees 10 lakh, depreciation is rupees 2 lakh, amortization is rupees 2 lakh 50,000 and loss on the sale of equipment is rupees this much. Then we have the changes. That means there is an increase in the accounts receivable of rupees 1 lakh, there is a decrease in the inventory, and then there is a increase in the account payable. So the total value accounts for 30 lakh 60,000, including the changes. Now, cash flows from the financing activities. Cash flow from the financing activities. It is as follows. Proceeding from the issue of the shares is 5 lakhs. Proceeds from the borrowings is rupees 3. And after that, payment of the loans is 2 lakhs and payment of the dividend is rupees 1 lakh. That the resultant is rupees 5 lakhs. Okay. Then the third comes the increase in the cash and cash equivalents. Net increase in cash and cash equivalents. This will be like net increase in the cash and cash equivalent is rupees 14 lakh 60,000. Cash and cash equivalent at the beginning of the period is rupees 5 lakhs. So that at the end of the period will be rupees 19 lakh 60,000. Okay. How it came? 1 lakh 60,000 from here. Oh, sorry, 13 lakh 60,000 from here. And then there is the increase in the account payable as well. So, now let us just talk about the importance of cash flow. Why is cash flow important? First of all, it accounts for the liquidity management. So that it ensures that the company has the enough cash to meet its short-term obligations, such as paying to the suppliers, employees, and other operational costs. Then second, it accounts for the investment decisions. Provides insights into the whether a company is generating enough cash to reinvest in the business, acquire other businesses, or invest in the new products. Then third is for the financial health. Positive cash flow indicating the strong financial health, while the consistent negative cash flow would signal the potential financial trouble. The next is the debt management. It helps in assessing the company's ability to repay its debts and manage its financial costs. And lastly, for the performance evaluation. Investors and the analysts can use cash flow statement to evaluate the performance and the sustainability of the company's operational and the growth strategy. So understanding a cash flow is crucial for managing the business effectively, making informed investment decisions, and assessing the overall financial health and the performance of an entity. So this was the quick overview about the cash flow statement. I hope you have understood it. Thank you so much.